Better System Trader, Episode 12.
Welcome to Better System Trader, the podcast to help systematic traders of all levels improve their trading. We'll give you loads of expert tips and practical advice on system design and validation, money management, trading psychology, and many other topics. Whether you're just starting out or a savvy systematic trader, we're here to help you improve your trading and find more success. This is Better System Trader with your host, Andrew Swanscott.
Welcome to the Better System Trader podcast, episode 12. I'm your host, Andrew Swanscott. Thanks for listening. This week's guest is an expert in the application of statistical models and software for trading currencies, futures, and stocks. He has built and traded numerous quantitative models for investment banks and hedge funds, and is now the managing member of a commodity pool operator and trading advisor, managing a hedge fund as well as individual accounts. He is the author of 2 books, a trading blog, and teaches courses and workshops in trading and finance. Today we talk about many aspects of quantitative trading, including how market crises impact momentum strategies and how to manage those impacts, when to use stop losses and when they don't make sense, automating trading, managing funds in a portfolio of strategies, and a simple money management approach which aims to limit drawdowns while maximizing returns. Today's guest is Dr. Ernest Chan. I hope you enjoy it. Ernie Chan, thanks for joining us today. For those people who aren't familiar with your work, could you please give us a bit of background on how you got started or how you got into trading?
Thank you for inviting me, Andrew. I actually did not start out, as a trader on Wall Street. I was a machine learning researcher at IBM. And I then worked for Morgan Stanley's data mining group in a sort of internal consulting role. However, some of my colleagues in that data mining group decided to move on over to Credit Suisse to start a proprietary trading desk using some of the algorithms that we have become familiar with, while doing consulting. And so I agreed to join them. And that's when I started really going full-time into the area of quantitative trading research.
Right, and how would you describe your style today?
Well, my style today has really evolved a lot from the days when I was, working for some of these big banks. In those days, I think one of the driving but undiscussed motivation is that you want to build something that is really different from everybody else and looks impressive on paper, at least, to justify the salary that they're paying you. In terms of the profit, it's great that it has profit, but if it's not profitable, you may not suffer the immediate consequence anyway. So that's the nature of trading for a bank, is that you get the upside, but you have a very limited downside. But when I become an independent trader around 2006, the downside is as important as the upside. So we don't have the luxury of building something complicated and trying to impress other people. We want to stick to the stuff that actually generate profit with limited risk. And it turns out that I found those are the strategies that are simple. And it does not require, a very fancy mathematical framework to work. And I have been adhering to this sort of philosophy for my trading since then.
Well, it's interesting to hear you say that, because you've got a lot of strategies in your books and on your blog. Where do your ideas for trading strategies come from?
Well, they come from a lot of different sources. Some of them are just, based on kind of straightforward market observation. You could say that it's based on logic. It's we categorize the sort of any market into 2 types. Is it mean reverting or is it momentum? And so for any market we go into, that's the first question we can study. So if it is momentum, then you can exploit strategies to benefit from this momentum. Now it depends on over what period of time is trending, over what regime that it might not be, and so forth. So that those are the details. But once you decided that a market is momentum, you can focus on using different kind of momentum strategy to extract profit. So a lot of these ideas are just basically based on logic, right? So that's how I came up with them, and a lot of creating hypotheses and testing this hypothesis based on this logic. Now, of course, there are others that are. I also read many academic papers, and basically every day you can read about academic research that suggests this or that market inefficiency in futures, in forex, in equities, in bonds, and whatnot. And a lot of these strategies are just very academic in the sense that they do not, for example, produce high enough Sharpe ratio, or they produce too much drawdown, or they don't stand up to transaction costs. But occasionally, some of these strategy will stand up to these stringent tests that a practical trader would need to apply, and we would absorb them into our trading system.
Okay, that's great to know. If we can just discuss momentum a little more, in your book you mentioned a phenomenon called momentum crashes. Can you explain a little bit about what that is?
Yes. Momentum crash is a phenomenon where in the immediate aftermath of a financial crisis, oftentimes momentum strategy performs very poorly. And this question has been studied by a very well studied by a professor of finance in the Columbia Business School. And the reason for that, and if you look at the history of, for example, the profitability of many futures traders or CTAs, you'll find that they did spectacularly well in the run up to the financial crisis in 2008, and then they all did very poorly in 2009 and so forth. And the reason is actually quite obvious. It's very simple to explain. When the market is crashing and you are shorting the market, no question that you are going to generate profits. But a lot of this momentum strategy use a several months look back to determine the momentum. They are not very short term. They do use a few months of data. Typical momentum strategy that the CTA use would be, let's say, use 11-month momentum in the last 12 months. The farthest 11 months in the most recent 12-month period. That's the standard recommended look back for momentum strategy. And so, of course, in the aftermath of a financial crisis, when prices are all rebounding, you are using this 1 year or 11 months look back. You are going to get a downward direction instead of catching the rebound, because the rebound may just have happened in the last few months. And of course, you will still be shorting, and you'll be severely hurt by your momentum strategy. And that happens to be true for many types of momentum strategy across the board. The study have found that, for example, momentum strategy, if you run a momentum strategy in the aftermath of the Great Depression in the 1930s, you would have several decades if you did that. Fortunately, for the most recent Great Recession, it only lasted a few years, the drawdown in momentum strategy, but that's enough to wipe out a lot of CTAs. One remedy for that, of course, is that you do not short. If you run a momentum strategy and you know that you are in the aftermath of a financial crisis, better not run the short. If you only run the long side, you are protected from that sort of drawdown.
So how could you account for this behavior when backtesting or trading a momentum strategy?
You can impose some rules to say that what qualifies as a financial crisis, right? If the market drop a certain percentage from the peak, that qualifies as a financial crisis, and you can test these rules to say that, well, if the market has dropped this much, I will stop shorting. But those are arbitrary. But so that's in general, yes, you might not get many trades if you only trade the long side, but you can only not short in the aftermath of this kind of drawdown, in the aftermath of financial crisis. Also, the other remedy to a momentum strategy is one that I use. I don't impose this ban on short sale. I trade both sides, but I also trade mean reverting strategy at the same time. So whenever you are diversifying across both momentum and mean reverting strategy, hopefully when one is in a drawdown, the other one is generating profit. And that's actually what's happening now in the market. In 2014, many of the momentum traders did very well because of the drop in crude oil, for example. I heard some of these people make over 100% profit. Good for them. But this year they are losing a good portion of that since the year to date. And I say, well, on the other hand, mean reverting strategy is doing great this year. And so if you're running both, you are essentially hedged in both cases.
Right, so while we're talking about the market dropping, let's have a quick chat about stop losses. It seems to be a hot topic at times. People have different opinions on if they should be used and where. So what are your views on the use of stop losses?
Yes, stop loss is a very reasonable and very logical device to use in momentum strategies. And the reason is that when you are running a momentum strategy and you are finding yourself in a loss, clearly the momentum has reversed, right? And naturally, you should consider either getting out of the trade or maybe even entering into the opposite side of the trade. So the profit is telling you that the momentum has reversed. And if you're running momentum strategy, you should not keep going in the wrong direction. So stop loss are perfectly natural, and they are actually triggered, supposed to be triggered, quite regularly in momentum strategy. You couldn't possibly guess correctly the momentum direction every time. So expect to be stop out often. However, stop loss is not logical in a mean reverting strategy, because if you believe that the prices, let's say the price are dropping and you enter into a long trade, you expect the price to go up, but instead it goes down further. Well, why would you be getting out? Because you are expecting that this price is even more favorable to buy. If you still expect the price to mean revert, you should be entering into more position as the price drop. So a stop loss does not make any sense for a mean reverting strategy. And in fact, if you back test any mean reverting strategy and you impose a stop loss, it inevitably decreases the profit of the back test. However, there's also there's a subtle bias here, and that is the sort of a survivorship bias in this sort of back test. In that, obviously there are mean reverting strategy that failed. It worked for a while and then the spread just keep increasing, or it worked for a while and it just bottom fell out of the market, or the opposite. And those are the strategy that we would not be backtesting. We would not be considering. We would reject them before even start backtesting it. For our mean reverting trading system. But how would we know that this good-looking mean reverting strategy that we are backtesting now is not one of those that will crash in the future? We don't. So there's always a possibility that some percentage of the strategy that seems to work now belong to the category that it will fail in the future and will never recover. So in other words, we cannot be 100% certain that what's mean reverting now will continue to mean revert in the future. And because of that, it is always a good idea to impose a stop loss to prevent catastrophe. And that is to cut off the tail risk where your strategy happened to be the one that just keep losing and will never recover. But that stop loss need to be set at a level which exceeded all the previous drawdown of your backtest. Because if it is set at a level that would have been triggered in the past, it would always result in a worse backtest. That would not be rational. So we would want to set the stop loss at a point where it is below the maximum drawdown of the previous of the backtest. And that way it won't affect the backtest, and yet it will protect us from those outlier cases where your strategy actually is one that doesn't make it in the future, and yet we will preserve your capital to fight for another day.
Right, so you're talking about a stop loss at the strategy level there, but how do you control the risk of it at the individual trade level if you don't have a defined exit at the point you get into the trade?
Well, the risk is defined by that stop loss. So, for example, if your maximum drawdown of the strategy is 20% and you set your stop loss at 21%, then the maximum risk your system will take is 21%, hopefully. I mean, now there are cases where stop loss doesn't work, of course, at all. If you are trading, equities, there are half the day that there's no trading. So if an event happened overnight, your stop loss will be blown through. It has no meaning whatsoever, right? So stop loss doesn't always work. Stop loss only work when your market is pretty much continuously traded, and also when you are not in, you make sure that you liquidate your position before there's a gap in the market. Excuse me, that for example, overnight gap, you want to liquidate it before the market close, or you, in the case of futures, you want to liquidate it on a Friday afternoon. That's the only situation where stop loss would work. Otherwise, it just won't work at all. But assuming that you do all that you liquidate before the market close, and that stop loss hopefully will be honored more or less. So that would be your risk level. You are not trying to prevent a loss at 10%. If you see your maximum drawdown historically at 20%, you could well suffer a 10% loss or 15% loss or even a 20% loss. The only function of the stop loss in this case is to prevent you from going over a 21% loss. So that's we do not we are not afraid of risk that are small. We are only afraid of risks that are bigger than what we can tolerate at the maximum.
So that leads nicely into a concept you cover in your algorithmic trading book. You discuss a position sizing method that basically it restricts your maximum drawdown level while still giving you the highest possible growth rate.
That's right.
You call it constant proportion portfolio insurance. Can you explain what it is and how it can be applied to trading?
Yes, that's actually a fairly simple concept. Essentially, let's say you only allow a maximum of 20% drawdown in your equity at any time. Now, that doesn't mean that, let's say you start out with $100,000, you say, okay, I don't want a maximum drawdown of 20%, so I don't want to lose $20,000. That's not what it means. It means that, let's say you make a lot of money over the next few years, and now your account become $1 million, right? You grow from $100,000 to $1 million. Well, the maximum drawdown would still be 20%. So you are actually now allowed to lose $200,000, right? So you're based on the percentage from the high watermark. We are not talking about a fixed amount, or a dollar amount of loss that you can tolerate. So that's, let me first clarify that. That's what this scheme is trying to provide. It's a percentage loss from the maximum, from the high watermark that we want to protect. Now, okay, so given that, the idea is simply that you will have, imagine yourself dividing your capital into a trading account and a bank account. So if you are given $100,000 and you say, well, I don't want to lose 20%, well, or lose more than 20%, then I say, okay, that's great. Put $80,000 in the bank. You know that money won't be lost, right? And only use the 20% to $20,000 for trading. And then, if you you can lever it pretty high, that 20%. You can lever it 10 times if you so please. It doesn't matter, based on Kelly criteria or some other method of determining what the optimal leverage is. You want to make sure that this $20,000 grow at the fastest rate you want it to. So, okay, that's fine. Now, if you're lucky and this $20,000 did generate a lot of profit, let's say it become $40,000. Well, what do? Well, we don't keep it going. We don't just keep trading it at this high leverage. Let's say 10 times leverage, and leverage 10 times it become $400,000. No, we don't do that. We will allocate some of this profit to the bank account. So we keep some of that. We keep some of that profit. So the bank account is now $80,000 plus some amount, some fraction of the profit. And then we use the rest of the profit, the retained profit, plus the original equity of $30,000 and keep trading it, let's say at 10 times leverage. So this way, if in case in the future it lose, it's okay, because we would still, at every high water mark, we are never going to lose more than 20% from that high water mark, because we have allocated some of that profit to the bank account, which we would not touch. Right? We would never take money from the bank account to the trading account. We would only take money from the trading account to put in the bank account. Now, let's say instead of making money in the next period, you lose some money. What do we do? Well, you lose some money, as I said, we don't want to make up for that loss from the bank account, because if you do that, you might well be creating a drawdown that's more than 20%. So no, we don't touch the bank account. We keep the money there, and we would just keep the leverage with a smaller equity. So you decrease the market value of the portfolio you're trading in the trading account. And so, if you are in really bad luck and you just lose more, in the next period, okay, well, too bad. You have suffered a 20% drawdown. But that 20% is the drawdown from the, from the previous high water mark, not from where you started off from at, 100. So you still have retained some gain in your bank account, but you have lost all the money in your trading account. So that's the way that we run constant proportion portfolio insurance. That's the way that we would keep a maximum drawdown from ever being exceeded in our trading, and yet be at the same time create a maximum return that is possible under this constraint. So this is sort of a constraint optimization problem. How do you maximize growth using maximum leverage, yet keeping the constraint that you would never exceed the maximum drawdown of, let's say, 20% of the portfolio.
And I guess if you're using the Kelly ratio for that 20% trading component, the likelihood that you would actually lose the entire 20% would be quite low, right?
That's right. Yeah. Yeah. I mean, Kelly is a theory that that does depend on Gaussian assumption of returns. But no matter what you use for optimizing your leverage, you will use that. Kelly is one of them. But yes, you want to maximize the growth of that small pot of money that you're at risk.
And if you were to take a trade or series of trades that were outside the normal distribution based on backtest results, would you recalculate the Kelly ratio?
Well, yeah, if you find that your distribution of return is really outside the rhyme of normal, you would not use the conventional formula for the Kelly leverage, which is the average return squared divided by the standard deviation of returns. That only works if we assume a Gaussian distribution of returns. So if you do find that your trading strategy has returns that are very non-Gaussian, you might have to go to first principles and derive for yourself what the maximum, the optimal leverage is. Still based on the principle of maximizing compounded growth, but using a different underlying distribution of returns.
In what cases wouldn't you use a strategy like this?
Well, you would use this as in all cases. This is a general risk management strategy, and it's unless you are not concerned about maximum drawdown, then you wouldn't use it, right? This is only useful if you want to impose the constraint that you don't want to lose X amount from the from the high water mark. But if you're not concerned about that, then you don't need to impose this scheme.
Right, so I was thinking more along the lines of a portfolio that maybe has multiple strategies in it. How would you apply this strategy to a portfolio like that?
Well, this scheme is actually indifferent to whether you are running a portfolio of one strategy or multiple strategies. It is really applied at the level of an account, right? As long as you are, as long as you have an account which may even contain multiple portfolios or multiple strategies, and certainly multiple securities, and as long as this account is subject to risk, then this method can be applied to it. It does not apply, of course, to an account which does not have risk. For example, if you are just holding government bonds in an account, there's no risk to it. It's always going to generate the same return year after year. Then this scheme would not be needed. But as long as you have an account where you have a market risk, that would be a good scheme to apply to it if you want to prevent the risk from exceeding the maximum drawdown.
Okay, thanks, Ernie. I'd just like to change the topic a little bit now to automated trading. Your book, Quantitative Trading, talks a lot about automating the trading process. So what are some of the challenges or factors that you need to consider when you're looking to automate your trading?
Well, the automating trading is certainly very much a technological problem. So, a programming problem. So the first challenge in any programming problem is to make sure that the program doesn't have bugs. And now in quantitative trading, it is particularly important that the automated trading program is executing the exact same strategy that your backtest has been running on, right? And oftentimes they are not, because the backtest program, you might be backtesting it in Excel or MATLAB or R or Python and whatnot, and then in the when it looks good, and then you want to implement an automated trading program, you say, hey, I don't want to deal with the data connection issue and so forth, so let me just hire a programmer to do it. And this programmer will go ahead and do it in Java, let's say. Well, how do you make sure that these two programs actually have the same logic? There's maybe some subtle differences. And that is a crucial problem in automating trading. So what we have discovered is that you want to make sure that the exact same program is used to both backtest and trade live. In other words, the program should have just a turnkey operation to turn it from receiving historical data feed to a live data feed that can generate live trades. So that's, I think, is one crucial method of ensuring that your automated trading system actually produce the same results, at least historically, as your backtest. Other things to consider when you are building an automated trading system is the order types used and the management of those order types. In your backtest, you might say, okay, let's execute. When the price is low, buy. Okay, and you assume that it's filled, and you get this amount. But in a live trading system, it's not so simple, because when you send an order out there, that the price may have moved, and so should you send a limit order out there, or should you just send a market order out there? Well, in both cases, there's some problem. If you send a limit order out there, if the price has moved against you, well, your order won't be your limit order won't be filled. You have an opportunity lost. What are you going to do with this limit order? Does it just sit there? Oftentimes in the mean reversion strategy, that's what you should be doing. Just let it sit there. But other times, it's you don't want to lose too much of opportunity. You might want to cancel your limit order and resend one with a worse price. So the order management become a problem when you are doing live trading as opposed to just back testing. And then on the other hand, if you say, okay, I don't want to lose any opportunity, I just want to get it filled, and you send a market order, well, in that case, you might suffer a great deal of slippage, especially in this day and age where liquidity is very thin. The slippage can be considerable. So the issues that are faced in a live trading program are usually much more complicated than that's what a backtest program will face. Unless your backtest program is so sophisticated that it uses the order book to backtest. Now, few independent traders have the capability of backtesting using the level 2 data. Most of us, at best, can use the level 1, the top of book quotes, to backtest, and many of us, and including myself in the earlier part of my career, simply use last price to backtest, and that will create a backtest result that can look very different from the live trading result.
Okay, that's interesting. I think for a lot of retail traders, that's kind of a fancy idea to think that you can just click go on your computer and it does the trading for you. I'm sure a lot of us have heard stories about computers or trading systems putting in additional orders or not executing correctly.
Right. Well, those fat fingers problem is a separate issue, though. The issue of the program actually sending too many orders. That I don't think anyone can swear that the program will never do, but at least we have tried to be as defensive as possible in our programming. But that really depends on the sort of the skill of your programmer. It's not the trader's problem; it's a programmer problem. Better hire a programmer that is extremely careful in terms of defensive programming to prevent that.
Yeah, especially when you've got money on the line.
Yeah.
Okay, thanks, Ernie. So I'd just like to move on to some listener questions that we have here.
Okay.
I'm going to start with Glenn. His question is, in your book, Algorithmic Trading, you mention the opening gap strategy and note that this is a breakout strategy that works for some futures and currencies. Have you backtested and traded this strategy against a universe of stocks? If not, could you please explain why?
Well, obviously, we have backtested this strategy against a basket of stocks. If you look at my book, actually, it detailed the backtest results of this strategy against a basket of stocks. What was the? Let me look at it to see what basket we used. I believe it used the S&P 500, right? In example 4.1, that was the example on this bar and gap strategy, and it was described that I use it on SPX stocks, and in Figure 4.1, that's the backtest result from S&P 500 stocks. I'm sorry, maybe I should also emphasize that the strategy works on stocks as well as on futures and currencies. So maybe Glenn was looking at the chapter that talk about it in the futures and currency chapter, but actually the strategy was described in full in the stocks chapter.
Okay, thanks, Ernie. Moving on to our next question from Matisse. The question is, where can the private trader look for trading opportunities in the competition against the big trading firms that have all the resources in time, knowledge, computer science, etc.?
Well, the easiest place to look for trade opportunities that are not already taken up by bigger firms is in strategies that have low capacity. I have oftentimes, in my first book, for example, I talk a lot about those seasonal future strategy, right? Trades that you might only get triggered once a year, like buy natural gas ahead of the winter, or buy gasoline before the summer. That sort of trade that is driven by sort of global consumer demand for heating and for driving. Well, those trades are well known, but they are not arbitraged away by the big firms because they are not terribly interesting to a firm that need to make money every quarter. Who wants to make money just once a year? But for independent trader, especially if an independent trader has a full-time job and just trade, part-time as a hobby or as a supplement to their income, well, this is the perfect trade because who cares that it trades once a year as long as it's profitable. So this is a kind of trade that sort of low capacity. Well, it's not really low capacity. You can put 50 million into a gasoline futures without any problem. But nevertheless, of course, you have to take the same risks. So it trades very infrequently. And other trades are ones that I mostly talk about in my book. None of the strategy, well, I shouldn't say none, but most of the strategies I talk about in the book will not support a $100 million portfolio. So I'm not afraid to write about them because I know that someone in Goldman Sachs is not going to suddenly read my book and completely, destroy the strategy because they don't have 100 million capacity. And these are the strategy that an independent trader should be focusing on because they make, as long as you can support maybe a $1 million portfolio, or even if a lot of people are trading it, read my book and suddenly go out and implement it, maybe $10 million portfolio would be good enough for independent trader. And that's the strategy that I find is actually easier to find and also better protected against competition.
The next question comes from Rich, who asks, generally I'm hearing that algorithmic trading and system development require intimacy with market microstructure. Generally, what is market microstructure and how do I learn about it? Do you have any good references?
I don't know that all algorithmic trading requires knowledge of market microstructure. It only requires knowledge of market microstructure if you are trading intraday, right? But there are a lot of strategy that, even I trade, that only requires trading once a day near the close or near the open, right? In that case, you just participate, let's say in the US equity market, you just participate in the opening and closing auction, then you have no need to worry about market microstructure. And also, for example, if you're trading futures or currencies, unless you are a huge trader that are trading, 500 contracts of the E-mini or $10 million of AUD USD, you again have no need to worry too much about market microstructure because you barely scratch the top of the order book. But if you are trading intraday, and particularly in the US equity market, where the top of book liquidity is usually just 100 shares, then yes, you do have to worry a bit about market microstructure. As to where to learn about it, first let me advertise that my course, millisecond frequency trading, is designed for that market. If you are trading in the US equity market intraday, that's what the course would discuss all the intricacies of the market microstructure that you would need to do as a practical trader. But aside from that, there are some books, such as, let me look at my bookcase. There's a book called Trading and Exchanges. And the author is Mr. Harris. Mr. Harris is a former security regulator and professor of finance, I think. So Mr. Harris wrote this book, Trading and Exchanges, that talk a lot about these issues. And there's another book called Broken Markets. Is more for not for quantitative traders, but talk about a lot of the issues in the market microstructure that might be relevant. And then finally, there's a book called Algorithmic Trading and DMA. That's by the author Johnson. That also has some relevant topics on market microstructure. But actually, there is there's an online resource. If you go to my blog, epchan.blogspot.com, in my article, most recent article on beware of low frequency data, I reference the teaching notes of Professor Joe Hasbrook. This teaching notes is precisely on US stock market structure. And he is, in fact, the world authority on market microstructure. So he has graciously, Professor Hasbrook has graciously made available his teaching notes for free. I don't know if it's still available online now, but when I last looked, it was. So if you go to my website, you click on that teaching notes link, and you will find good information on that topic.
Thanks for those recommendations, Ernie.
Nope.
The next question is from Tom regarding the techniques of sector rotation, that is ETF or sector-specific funds. So firstly, he would like to know if you have done any work in that area, and if so, what have you found to be the most successful or robust?
I have been looking into trying to develop sector rotation strategy for, maybe more than 10 years, and I have never succeeded. So some recent ideas that I have is perhaps you can use order flow into a sector and to compare it. I have not tried, but that seems like a new potential avenue is to compute the intraday order flow into all the stocks in one sector and then aggregate them and see whether there are these telltale signs of mutual funds buying into a certain sector. But I don't know if it works, just an idea.
So my next question is from Ryan. His question is regarding the efficient allocation of funds to individual strategies in a portfolio that has multiple strategies. He would like to know, how do you allocate funds to strategies where the timing of the signal is unknown? Would one strategy receive all of available funds when the first signal triggers, or do you have a preference for pre-allocating funds into individual strategies, then executing using a smaller pot as each strategy triggers?
Yeah, it would be the latter. If the strategies have overlapping time period, right? So that's the first thing we have to clarify. If you are running one strategy only intraday and the other strategy only during the overnight gap, they don't have overlapping time period, then both of them can get full allocation of your buying power. No problem with that. But the only problem occurs when they are competing for the buying power during the same time period. If that's the case, then yes, we have to pre-allocate. We have to assume that whatever strategy that it's generating better return should get more buying power, and the one that generate less return or have a less carry leverage should get less buying power. So yes, pre-allocation is my preference.
Thanks a lot. And Ryan has a second question here. He asks, do you have a view on the optimal number of strategies to run at any given time, and is there a threshold amount where you enter into the realm of diminishing returns?
No, there's no maximum number of strategies you should run at any time. You should run as many as you can find, because diversification always decrease risk unless you keep generating strategy that are perfectly correlated with existing ones. Then that would be certainly futile, but that's unlikely in practice. Even if two strategies are correlated, they are not 100% correlated, and it's always good to therefore divide the capital into two to run them simultaneously. There's no threshold, no maximum at all.
Great. So I'd just like to wrap up with a few quick closing questions. The first one is, what's the biggest lesson you have learned through trading?
Yes, the biggest question, the biggest lesson is not to be overconfident of a strategy, in the beginning at least. Oftentimes we see great backtests and then we see that the strategy ran well for, 3 months. We are tempted to allocate 150% of our equity to it. That usually is not well advised. One should always be patient and be sort of humble in the face of the market. You should always prepare think about the worst case scenario. It will be a good antidote to overconfidence. And I have suffered that multiple times in my career, and hopefully I have finally learned the lesson.
I think we've all done that. That's great advice. Thanks, Ernie.
Yeah.
What's the hardest part of trading?
Well, the hardest part of trading is really to decide when a strategy has really died and should be discarded, right? Because every strategy gone through drawdowns, and sometimes they can be long and painful, but one really need to have a discipline to figure out if this strategy has really died or whether it is just a statistical fluctuation that should be ignored. And there are certain rule of thumbs to help us to decide if it is something to be discarded, but nevertheless it's oftentimes comes down to a judgment call in the last analysis.
Okay, great. And what's the best trading advice you've ever received?
Well, I guess I can say that don't over leverage is the best advice I have received.
Okay. And do you have a favorite trading book?
Well, I don't have, I guess, a single one. I've read quite a few good books. For example, on options trading, Yuan Sinclair's, he's a New Zealander, that we just ran into in the trading show Chicago. His books, he had a couple of volatility trading books that, you know, I really like. And, other than that, there is, there are just too many, good books that I've read. I can't come up with a single one other than the one that I, just run into, because his conversation is still fresh in my mind. That's why I can come up with his name.
And what's the best way listeners can get in touch with you?
Oh, they can always visit my blog. I respond to every comment on my blog. So that's a great way to discuss topics of general interest. But if there's anything that is more, proprietary or specific that we want to discuss, they can always email me. And my email is also on my blog as well as on my website, epchan.com.
Okay, so thanks so much for your time today, Ernie. Is there anything else that you'd like to mention before we wrap up today?
No, I think that I just want to close by saying that trading is a pretty tough business, and do not expect to succeed in a short time. It took me, as I wrote in my books or blog, 10,000 hours of work to get to some profits.
Yeah, but it's well worth the effort though, isn't it?
It is worthwhile, yes.
Okay, fantastic. So I highly recommend everyone go and check out Ernie's blog. It's got a lot of great research on there, and also his 2 books, which are excellent resources as well. I'll have links to those in the show notes. So thanks a lot again for your time today, Ernie. All the best.
Thank you very much, Andrew. Good to be here.
Okay, bye.
Bye-bye.
What a great chat with Ernie this week. Here are a few quick points I picked up in our chat today. Simple stuff works. Ernie has worked for some big-name investment companies that had enormous resources, perhaps unlimited resources. In those environments, he was exposed to the greatest minds and work, but when he went out on his own, he chose the simple stuff. He wasn't out to impress anyone with complicated strategies. It was all about what worked, what made money, and that was the simple stuff. So I'm sure we've all been guilty in the past of dismissing a strategy because it seemed too simple, or perhaps we've even overcomplicated a strategy. I know I've done both of those, but it's a good idea to keep simplicity in mind. I really liked his constant proportion portfolio insurance concept as well, which aims to limit drawdowns and maximize growth under the constraints of the drawdown level. If you're in a situation or you have a preference to limiting drawdowns to a specific level, this could be a strategy that you could employ. I also found his comments on momentum crashes interesting. Momentum strategies can take a while to recover after a financial crisis, and he suggested one way to manage this was by trading mean reversion strategies as well. So those are my top 3 points for this episode. Don't forget to check the show notes for this episode where we have additional information and links to his books and other resources. The show notes are available at bettersystemtrader.com/12. Check it out. Also, a big thank you to all the listeners who submitted questions for Ernie this week. If you'd like to submit a question for future guests, make sure you're on the Better System Trader mailing list, and I'll send you an email when the next opportunity arises. Anyway, that's it for this episode. We've got a big one lined up for next week. I'm not going to tell you who the guest is just yet, but I will start tweeting about it next week or the middle of next week, so keep an eye out on Twitter for more information. You do not want to miss it. Anyway, I hope you enjoyed the chat with Ernie this week. Thanks for listening to Better System Trader, and I'll catch you next week. Ciao.
Thanks for listening to the Better System Trader podcast. The next step is to head over to bettersystemtrader.com for more expert tips, practical advice, and exclusive content. Catch us next time for even more great ways to improve your trading here on Better System Trader.